what are some of the biggest mistakes that you see when people are applying for finance? So if they're trying to get all their house in order, what are some of the things that maybe they should be considering?
Look, some of the things that need to be taken into consideration is people need to make sure, first of all, that they're not borrowing more than they can actually afford. They need to make sure they have a budget up front and that they've actually practiced, and I said this on the last show, practice making your repayments before you start your mortgage. If your mortgage repayments are going to be $3,000 a month, practice starting making those repayments up front before the mortgage settles, and make sure you're comfortable with those repayments and you can still have a lifestyle. Also, assuming everything will be okay with because you know your bank manager and you've spoken to your bank manager. Well, your bank manager isn't always going to be there, and unfortunately in the big banks the bank managers do frequently change over, probably every 12 months. So you need to take into consideration that you really do need a pre-approval, not just relying on your relationship with your bank manager. Choosing the wrong lender and shopping around too much can affect your credit rating. It's really not good if you're applying for 2 and 3 lenders. Each lender that you go to can actually see that you've already been to other lenders and potentially had finance approved or declined, and they can't tell whether it's been approved or declined, so they don't know what they should be looking out for. Most of the time they'll actually assume it's been turned down and you're having troubles rather than you're shopping around on rate. That's right. They think, oh gosh, what's wrong with this application? We better look through it with a fine-tooth comb because something here's not right. And that may not be the case. The case may be that the buyer might be just shopping around for the best rate, and that's not the way to do it. Also, not having genuine savings. Really, the banks want to see that you've got genuine savings in your bank account for 3 to 6 months before you go ahead and get a pre-approval and buy. They want to see that you've got some kind of history of actually saving some money. And not understanding postcode restrictions. I brought this up earlier. You need to be aware of the postcode that you're buying in and make sure that lender is willing to give you finance at a certain percentage in that postcode. Some lenders will restrict you to a 90% or an 80% or even a 60% LVR based on the postcode that you're looking at buying in. So it's really important that you chat about that with your lender or with your broker. And so with a lot of those postcodes, a lot of that can be, like I know coming out of the boom before, say for the Docklands in Melbourne and for Piermont in Sydney, then quite often they're only lending 80% on some of these towers because it wasn't necessarily, I mean, sometimes it might be because they didn't like the building, but they suddenly had a massive exposure. If there's 1,000 units in there, they don't want to be financing $500 million worth of mortgages or $1 billion or whatever. They need to get exposure. And so suddenly if you think you can get a 95% lend, you might only get 80% on that particular property. That's right, and hypothetically, if CBA or St George have done most of the lending in that building, they will start declining applications because they're getting too many for that particular building. They'll want to share it across other lenders to reduce their overall exposure and reduce their risk. And also things like if you just get land only and there's no property on there, you're not getting rent. If you're going to outer areas, to more rural kind of things, again, it's not something that the bank can sell overnight, so they obviously see it as more risky. Yep.